All right. So everyone in the class, very good morning, very good morning. Welcome to the second lecture of our full English exam focused regular batch. Everyone for the subject of CA Final AFM. Are you all there? Am I clearly audible, visible to you? So who all do we have in the live class today? Please say something in the chat box so that I can know your names. Yes, come on. Shruti, very good morning. Nagendra Babu, very good morning. Priyanka, sorry, very good morning. Who else? Come on. How are you guys? Is everything all right? Harshita, good morning. How was your Sunday? Jashwant, bro, very good morning. Do you people have any choice of subject so far based on your learning at CA Inter? So in CA Inter, you are done with you have seen subjects like costing, financial management, accounts, auditing, DT, IDT. You have seen multiple subjects at CA Inter level. By chance, have you come to a choice among those subjects? Has it happened by chance, everyone? What do you all say? Quick. What do you all say? Ace Archana. Archana. Yes. Hi, Archana. No, you're not late. You're not late. We just started. Very good morning. So, people, did you have by chance any subject of your choice at CA Inter? Sir, actually, if we tell you, the CA itself is not by choice. It may happen to some people. So, to how many of you, CA was not a choice actually? It was a decision taken in flow, or it was a decision because my friends were doing it. Something like this. Harshita, no subject. Archana, FM, honestly. Is it because I am your FM teacher? You have to say the FM. The same answer you would give to DT teacher as DT. Shruti, FMSM. Purshi, is that your first name? Very good morning. So when I was in 10th standard, you have to choose a subject whether you're going to do, for example, whether you have to take the commerce stream or the science stream. So for example, I've taken commerce stream. Then at commerce stream, we were exploring various options like whether I can do MBA after graduation, obviously, I can do CFA or CA or whatever set of things. We realized that I started to do the knockout, as in I started to make the negative list that what all I will not do. Perfect. So that way some graduation courses got eliminated, right? That in the 3 years of time, if I graduate, then I think it is more worthful to do CA in 4 years of time. That happened, then we realized CFA is an option, but at my time back then, you can do CFA only when you're graduate, right? And if that is the situation, better to do CA to take one more year and then do CFA. Similarly for MBA, if you do MBA first, you have to do graduation. So that way, I opted for CA not from my choice perspective, that this is my choice to do CA. Rather, kind of I was not having any other option other than to do CA. At that moment, later on, I had a choice to do whether, CFA, or I could have picked MBA in finance from good business schools. But at that moment, it was CA, not out of choice, but because there was no choice. Frankly, I'll be upfront. That is when I, after doing CA, realized that there is something more beyond it I need to do of my interest, which is when I had to choose CFA. So that was the thing actually. So at some point I will share my life story, and I will share you how come almost nothing in my life happened according to my choice. I chose something and things turned out to be something else only. I'll share that example, not now, in a later class. But yeah, as of now, I think we are sorted. Shall we start our studies, people in the class? So very good morning, all the live people. Shall we start our studies? What do you all say? So, Before I make you people revise the things that we have done yesterday, let me come to you with a quiz. Super fast quiz. Let me come to you with a super fast quiz. So you are done with IRR, you are done with cool. My first question to you all. Suppose. Are you people ready? Should I start with an easy question or directly a difficult level question? What do you all say? These are the questions I'm asking just to evolve your brain, not necessarily the same question may be asked as it is in the exam. But yeah, it will surely evolve your brain, make you capable of doing some reverse calculation question that institute asks. Suppose my sales in a particular business is rupee 6,000. Suppose my net profit margin is 10%. Suppose the share capital invested in the business is 600. Suppose the reserves and surplus invested in the business is 2400. My question to you all is, can you please help me calculate return on equity through this data? Please. Can you please help me return on equity through this data? Come on. All the live people sitting here, all the recorded people must try to calculate return on equity. Come on. It's an easy one if you all realize. So easy actually. Sir, sales multiplied by net profit margin give you net profit. Do you understand the ratio? Net profit margin tells you, it is not the formula, it is an understanding as well. Net profit margin tells you that what percentage of your sales is net profit. So 6,000 multiplied by 10% give me net profit of rupees 600. Perfect. Now my total equity shareholder fund invested in the business is 3,000. So basically the common sense is, when it comes to ROE, in the denominator comes the amount of equity capital invested as per balance sheet, and in the numerator comes the amount of profit earned for equity as per income statement. So profit earned is 600, amount invested of them is 3,000, giving me an ROE of 20%. People in the class, brilliant. Perfect. I'll take you now to the next level. Just give me a minute. Can I say ROE to be inverse of PE ratio? True or false? ROE is the inverse of PE ratio. True or false is what you will have to answer. Kaneka, very good morning. Come on. All the recorded people, live people, come on. ROE is the inverse of PE ratio. True or false? 1,000 rupee question. The student who answers this question correctly will be immediately transferred live. Like what I say is getting recorded. So I'll immediately transfer a live 1,000 rupee to this question to every student who answers this question correctly. Yes, come on. I'm giving every student a chance to rethink an answer. Come on. False. Some people are saying true, some people are saying false. Sir, if I talk about ROE, if I talk about it on a per share basis, it is EPS divided by book value per share. It is all based on financial statements. P ratio, on the other hand, is MPS divided by EPS. It is the ratio based on the market price. Sir, even if I do inverse of ROE or if I do inverse of P. So ROE inverse is book value per share divided by EPS, which is not same as P ratio. So my statement was false. And the answer to this was no. So some people have answered it correctly. For example, Shruti, Harshita and Jashwant have answered correctly. All of you get a chance to win an iPhone 17 Pro Max. In fact, Ultra Pro Max. Fine. Cool. So, do you really want money? That 1,000 rupee which I committed? What do you all say? Come on, what do you all say? Oh my God, I have never seen students like you. I'm offering to you money and you are saying no, sir. Knowledge is more important than money. Respect and relations are more important than money. Shruti and Harshita are saying no, that we don't want money. Is it? I respect the teachings your parents have given to you. They have made you people realize at a so early age that money is always secondary. It is always the relationships and the knowledge and the values that you learn is over and above money. Is it? Like, really, I have never seen the students like you. Oh my God. Shruti and Harshit, are you feeling now bad about it? So my next question to you all. Well, jokes apart. Every time I offer you money, please know that you will never get that. That is just to create curiosity in the question. All right. Not because I don't want to give you. I'm willing to give you. But I know that you won't accept it. You will give it back to me. That is why. Well, sir, my next question to you all. If the inflation premium in the market increases, if the inflation premium in the market increases, will the real required rate of return be affected? If the inflation premium in the market increases, everyone in the class, will the real required rate of return be affected? What do you all think? What do you all say? Come on. No. Okay. Okay. If the inflation premium in the market increases, will the risk-free rate? Please always remember, if I don't say anything, the risk-free rate or any given rate is always nominal. So if the inflation premium in the market increases, will the risk-free rate, which is nominal in nature, be affected? What do you all think? What do you all say? Come on. Almost the last question for the day. People, what do you all think? Some people say yes. Some people say no. Recorded people, what do you all think? Sir, risk-free rate, even if it does not have any risk, it is something you will have to always remember and please learn it. Even if it is a risk-free rate, if it is nominal in nature, which means the element of inflation is already incorporated in it, already included in it. Which means if the inflation premium increases in the market, then the amount of the risk-free rate of which inflation premium is the part, that will also increase automatically. Could I please convey that to you? Come on, everyone in the class. Could I please convey that to you? Because the real risk-free rate that you want to earn, you would want to continue to earn that. Perfect. But due to increase in the inflation in the market, you would want to earn now a higher inflation premium, increasing overall your risk-free rate. Could I convey to you the underlying logic, people in the class? Kindly respond to me on this particular thing once before we proceed ahead. Come on, come on, come on, come on. Everyone in the class, people, please, super fast. Could you get it? Do you allow me to ask you one more question? I feel like asking it. It just ran into my mind. In your understanding, Rudra, all the very, very, very best for your exam. It being your first paper today, wishing you all the very best. I know you are going to make it really great, really, really, really great. All the very best to you, to every student for the exam. Yes. So, anyways, back people. In your opinion, practically, dividend rate versus dividend yield. In your understanding, which of the two rates in the practical world do you think is going to be higher? In your understanding, come on. One is dividend rate, another is dividend yield. In your understanding, which of the two rates is generally higher? People in the class. Super fast. Then next 5 minutes we will revise everything. Then we will start to learn the new things. Sir, dividend rate obviously. Why? Because sir, if we observe the numerator is same. Denominator, if we talk about market price of the share, generally saying is way more higher than the face value. Since market price, which is a denominator, is higher, so yield generally is a lower number. A dividend rate generally is a significantly higher number. That was everything we wanted to discuss for the day, right? Sir, let's get back a super quick revision and then we start to learn the new things. Yes, shall we all get started? You can say yes by liking this video particularly. Come on, live people, recorded people, shall we start? Are we all there, set to get started? Yes, everyone. So. Come on, people. What it says, sir, format of income statement we had done. Sir, revenue, you deduct COGS, you get gross profit. You deduct the other two cost, admin, general, sales and marketing, you get EBITDA, or also called as cash profit. From which if you deduct depreciation, you get EBIT or operating profit. Which means from the revenue, if you deduct all for operating cost, COGS, admin, selling, and depreciation. These four costs, if you deduct from revenue, you get operating profit called as EBIT. From that, interest if you deduct, you get PBT. Tax if you deduct, you get PAT. Sir, preference dividend if you deduct the earnings, which is all available to equity shareholder, is there. EAES is what we call it. And paying the equity dividend leaves you with the retained earnings. Perfect. Then people in the class, you calculate equity per share as the total earnings of equity divided by number of share of equity. Total earnings is EAS. In the absence of preference dividend, it can also become PAT divided by number of equity share. Book value per share is simply the total value, the per share value of the equity as per balance sheet. So first we find out the total value of equity as per balance sheet, called as equity shareholder fund. Perfect. That divided by number of share is the book value per share. So the question is, what is the total value of equity as per balance sheet? If you imagine the balance sheet, you can either choose to go from the liability side or from the asset side. From the liability side, adding the equity things like share capital, reserves and surplus. And if there is anything unamortized in the asset side, that you will have to deduct. Similarly, if you talk about the asset side, then all the assets if you take, from that if you deduct the external liabilities and also the preference share claim, then what you're left is only with the residual claim of the equity, which is what the equity shareholder funds will be. Just remember one particular thing, that when you add up all the assets, don't include the assets which are fictitious, for example amortized expenses, etc., because actually they are not your assets. Fine. Then we talked about the return on equity, a formula which is all based on the financial statement, which is EAS divided by equity shareholder fund, or EPS divided by book value per share. Then we learned about the market cap, the total value of the company as per market. If I calculate the total value for all the shares, then it is total market cap. If I calculate the market value only for the free float share, then it is free float market cap. Perfect. The shares which are held, not held by promoters, are called as free float market cap. Then everyone in the class, next is P ratio, which is simply MPS divided by EPS. Fine. P, if you have to sell any asset, higher is better. If you have to buy any asset, any share, lower is better for P ratio. Then we talked about the dividends. Dividend per share is the total amount of dividend divided by the number of share, which in percentage terms can be spoken or can be, presented in three ways: dividend rate, dividend yield, dividend ratio. Rate is as a percentage of face value, yield is as a percentage of MPS ratio, right? Dividend payout ratio is as a percentage of EPS, right? So 1 minus dividend payout ratio can be considered as retention ratio, because whatever you earn, a proportion if you distribute, then rest of the proportion people you retain, which is retain earning per share divided by EPS. The concept of uh, the impact of dividend on the price of the share was really easy. That was all considerable. Then we learned the different types of return, right? Required rate of return, people in the class, comprises of three elements. Even if there is no inflation, even if there is no risk, I would want to still earn a return called as risk-free interest rate. If there is no if there is an inflation premium, then I would want to also earn inflation premium. If there is a risk, I would want to earn a risk premium as well. Perfect. Cool. Fine. Sir, then you have expected rate of return, which is P1 minus P0 plus D divided by P0 is the formula to calculate the expected return. There was a difference between required and expected rate of return. Listen to my line very carefully. Everyone, please pay attention. I am saying the required rate of return is the return I think I will be able to earn. I estimate that I will be able to earn as required, whereas what I need to earn is the expected rate of return, true or false. Come on. Everyone in the class, true or false? False. Sir, what you need to earn, what you require to earn, the minimum rate of return you need to earn is the required rate of return. Whereas what you think, what you estimate you will be able to earn based on the future prices and the future expected dividend is the expected rate of return, which is P1 minus P0 plus D divided by P0, broken down into capital gain yield and dividend yield. Yes, perfect. Sir, then we talked about the internal rate of return. We say it is a technique actually. To calculate the rate of return one could earn, for example, if you invest 100 rupee today, against which you will get 60 and 70 over the 2 years, there is some return you have earned, but how much, that is what IRR is going to tell you. If it is about the cash flow is future cash flow, then the return is called as the return of future. If the cash flows are past cash flow, then it is the return of past. The time doesn't matter. The point is IRR means. The IRR that you calculate means it is a compounded per annum rate of return. Compounded per annum rate of return. 1 second. One word is missing. Compounded annual rate of return. Actually earned if it relates to past, or to be earned if it relates to future. Sir, that is what IRR is, for which we know. What is my earning? Sir, using a particular rate, if I discount these future cash flow. So the rate at which future cash flow, present value of present value of future cash inflow is equal to the initial cash outflow, that is my IRR. Which means 60 and 70 when divided, when discounted using a particular rate, the present value of that should be equal to 100. That is my IRR, and you should realize that there is no direct mathematical way to solve it very easily. So what do? We assume a random number like 15, 20 and get the present values. But I know that if rate is 15, the present value is this. If the rate is 20, present value is 98. If I want my present value to be 100, then what should the rate be? That is when we interpolate the rhythm for theme for that was really easy. This minus this divided by this minus this is equal to this minus this divided by this minus this. People in the class, can you at this point again try to solve it on the calci to figure out if you are still comfortable with this calculation or not? Do try to solve it on the calci and give me what do you get as the answer on your calculator screen. Come on. All the live people, all the recorded people, let's do it right now. Super fast, please. Come on. Do calculate it. 18.929 gives you 18.93%. Fine, Priyanka. Others in the class, what do you all say? Just give me a minute now, please. Just give me a minute. 18.9 to 18.929 is 18.93. Everyone, are you all there agreeing to it? Anyone, any struggle, please let me know, because at this point we can learn to do the calculation again. If we are set, let me try to justify to you. We're not going to write it, but we are going to just learn it on the calculator. To justify to you, I'm just trying to prove you if the rate of 18.93 is correct or not. Perfect. So everyone in the class, let's try it. Suppose you take 100 rupee, you invest 100 rupee. I am saying that your annual rate of return is 18.93%, which means by the end of first year, you should get how much? 100 plus 18.93%, which means if you invest 100 rupee year, by the end of first year, you should get 18.93 rupee. Logical? Logical. This is the rate of return that become due by the end of first year. Sir, out of which if you receive 60 rupee, then can you please tell me how much is the amount of principal due at the end of first year? 118.93 minus 60 give me 58.93. Agreed, sir? Fine. This is the closing amount at the end of first year to be received, correct? Or I can say it become the opening amount of second year due. On which, on this balance, if you again earn 18.93%, can you tell me how much is the amount that become due? Plus 18.93% become 70 rupee which gets due, 70 rupee which gets due. So at the start of the year, start of the second year, 58 rupees was due, on which if I earn 18.93%, 70 rupee become due for the end of second year, and that is the same amount you receive at the end of second year, which means, do you agree? Whatever was due using the rate of 18.93% has been received and zero amount is yet to be received. Could I kind of justify to you that the return actually earned on a per annum compounded basis is 18.93%? People, Do you agree to what I said? Do you agree to what I said? Do you agree with the justification of how is IRR actually showing the rate of return we have earned? Yes, people. Yes. So now let me figure out what should be the plan for the day. One possibility is to understand the rates of returns. Cool. For now, cool. People, are you all there? Are you agreeing with the justification? Could you do it on your calculator? If no, so at any point, if you feel that, sir, we need to know something in this, you will have to please speak up. Yes, please be upfront. Please don't hesitate to ask anything. Because at some point, if I feel that I did not get a response, that my primary assumption will be you got it. So you will have to speak up if you feel that, sir, I'm missing it, right? So now we're gonna learn the calculation of present value, future value. Again, it is something which you must have learned at CA foundation level, then applied at CA inter level. But right now we need to practice it to make sure that later on we don't have any struggle with this. Are we all there? Should we speed up on this? Everyone in the class, super fast. Perfect. So let's say, for the next 4 years, these are my cash flow of rupee 200 each. Rate of interest is 10%. In this column, we will calculate the future value of the cash flows. In this column, the present values. Perfect. Sir, we have to first of all calculate the future value of 200 rupee of today. Today means on the timeline. Please imagine it. In AFM, if you ask me, sir, what is the most important thing? In the entire AFM, if you ask me what is the most important thing, I would say imagination of any concept on the timeline. Meaning to say, if I have, if I have, this is 0 year, this is 4 year. Question is, if I have rupee 200 here, how much will be the future value of that 200 rupee here is the question actually. For that, do we know the basic equation that present value multiplied by? In fact, future value is equal to present value into 1 plus r to the power n. 1 plus r to the power n. Agreed? Or in fact, I can write it at a more detailed level. Sir, future value is present value into future value factor. Cool. How do you calculate the future value factor? Future value is equal to present value into 1 plus r to the power n. In our case, n is how many years? Sir, n is 1, 2, 3 and 4. Rate of interest is 10%. So answer simply, people in the class, is 100 plus 1.1, which is 1 plus 10% to the power 4. What do you get as the answer, everyone in the class? Please give me the answer. People, please give me the answer. And also just give me a second. Can you all please give me the answer, waiting? Come on. What do you say? Oh my god, I didn't get the answer. What's happening? What's happening? Nagendra Babu say 146.1, Shruti say 146.1, Archana say 292, then Nagendra Babu give me the revised answer. Come on guys, what are you doing? Sir, I hope you know this much how to do calculator. Sir, it is simply 1.1 to the power 4 multiplied by 100. How many of you feel genuine? I need a genuine response. How many of you feel that, sir, we should write down the calculation steps? Please, super fast. How many of you feel that calculator step we should write down? Because it's something you must have actually read somewhere. However, if you feel that no, sir, we have not learnt it and we need to remember it, we will write down the steps. Only thing is that all these things will take time. Super fast. Please. No? Oh my god, please answer. Okay, my bad. Got it. Navin Babu, I got it. Where is the mistake? So, my bad. Sir, you have to take the present value to be 200, which is at this point, and now we have to calculate future value. Now I got it. Right? Sir, if you feel like writing down the formula, the calculation of future value factor is really simple. Sir, it is 1 plus, or I can say it is 1.1, then into, then equal to, you have to do 3 times. So 1.1 into equal. When you do it 3 times, automatically you get the future value factor, and once you get the future value factor multiplied by 200 gets you 292.82. 292.82. Similarly, everyone in the class, next situation. If you have an amount of rupee 200 at the end of 4th year, sir, what is its present value today? Do you people first of all realize the amount received on a future date is a future value? So if you have 200 to be received here, what is the present value of that today? Again, it is a common sense. Sir, you can think it two ways. I can say present value is nothing but future value divided by future value factor. So sometimes it does happen that you know the calculation, but I still want to present it in terms of formulas because it may be of use at some point to you. Sir, it is nothing but the modification of the same formula. Correct? Sir, what will it be? Sir, or I can also say it as future value into present value factor. Both the things mean the same. Right? You should be able to logically understand what's happening. And sir, question is how do you calculate it? So again, really simple. Future value is 200 divided by 1.1 to the power 4, or I can first write down 1 plus r to the power n, or you can say it's 200 into present value factor. How do you calculate? Directly on the calci. Sir, it's like 1.1 divide equal, so it is 0.683. 0.683. If you don't want to use any kind of formula, so directly you can use this, and let me show you the calculation steps. I think the obvious calculation steps. It is what, people? It is what? So it's like you have to take 1.1 on the calculator, then you have to press divide, and then you have to press equal to. How many times? equal to is how many times? Sir, 4 times. So the point to remember, although an easy one, but the point to remember is that when you have to calculate to the power 4, you have to press equal to only 3 times. Oh, let me write it down. Only 3 times. However, when you calculate the present value calculation, you have to divide it with 1.1, and that you do 4 times. Particularly, you will have to remember. So, sir, 0.683 multiplied by 200 is 136.6 is the answer to this particular situation. Are you people 10 on 10 on this particular thing? Come on. Yes, sir. Next, please realize this is something very basic that I should ideally not be teaching, especially with writing down the calculator step. But later on, at some point, should not be struggle to you, which is why we are doing all these things. It will somewhere clear your basic things, but against that is a condition that you will have to be very attentive, because we would want to learn them, but at a higher pace at least, because this is not new to learn for you. Sir, next. This time, let's imagine that your periods are actually not 4 years. They are 4 semi-annual periods. They are actually only 2 years. So let us try to figure out what I'm trying to say. I am trying to say that they are actually 2 years, 1 year and 2 year. But there are actually 4 periods, 0.5 year and 1.5 year. So if there are 4 semi-annual periods of 6 months each, if there are total of 4 years, right? And if you have rupee 200 as your present value, what would the future value be in that case? Sir, what is the rate of interest? Rate of interest continue to remain 10%. Always remember that if nothing is mentioned in front of any rate given in the entire syllabus, it is always per annum. So rate of interest is 10% per annum that we are agreeing to. Question is, how do you calculate the future value? To this particular question, if you answer, I would appreciate. Come on. Super ultra fast, everyone. This particular question you answer, I would appreciate. And this is something very basic. You will have to use it across AFM. So super fast. Come on. Try to answer it. You answer it. In the meantime, I will think which one is a better way to explain. There are actually two ways to explain to it. Some people say it is 243.10. Some people say it is 242. Is it the number, everyone in the class? Sir, how is it different? So let me tell you, we agree that future value is equal to present value into future value factor. The question is, how do you calculate the future value factor? So present value is 200 rupee. Sir, while calculating the future value factor, you should remember the formula. Formula is 1 plus R by K to the power nk. Sir, now what the hell is this? Let me tell you, it's a really simple thing. 1 plus r to the power n, you already know. But if my compounding is semi-annual, please observe what is happening. Do you agree? For a particular period, sir, what is my one period now? The one period is now 6 months. And how many such periods are there in total? 4, which means if you compound one time every period, then in total there will be 4 compoundings in a period of 2 years. Correct? So this formula is again this formula, what I've done is a common sense. Sir, it is just, you know, converting my annual rate to the periodic rate. For example, what is the rate of interest per annum? 10%. Agreed. But do you agree? You have two compounding in a year. You have two compounding in a year every 6 months. Yes. So if you divide the 10 by 2, you will get the compounding rate of a particular period, which everyone in the class turns out to be 5%. So what I've done? 200 people in the class, 200 multiplied by 1 plus 0.1 divided by 2. So this is nothing but rate for a particular period, making it 1.05. Agreed? For a period, the rate is 1.05. Now you apply common sense. How many such how many such compoundings should happen? How many such compounding should happen in a period of 2 years? Sir, total of 4 compoundings. Correct? Yes. So sir, if my life is total 2 years, but in a year k is 2, which means my compounding frequency is 2, so total of 4 compoundings will be there. With this mindset, if you try to solve this particular question, sir, what it turns out to be 1.1 divided by 2 plus 1 into equal whole multiplied by 200 give me 243.10. So answer, people in the class, those who had given, is absolutely correct, but the formula is equally important. Yes. Yes. How do you solve it on the calculator? Now should be easy. Hello. Hello. So Archana says, sir, just a suggestion. In the beginning, it'll be helpful, like how are you teaching the calculation steps in calculator? You want me to continue with it? All right, Archana. Done. Makes sense. So in the initial chapter, we will make sure that we learn it in the manner that every single student in the class learns. Those who already know things, learn. Those who don't know anything, also learn. So I will continue to do that, Archana, don't worry. People in the class, could you connect to this particular concept? Please tell me. So you know what is more important? More important is writing down what everything meant. For example, R is rate, but more importantly per annum. R is rate per annum, which means for the entire year rate is 10%. 2 is my total time period, but in terms of years, so 2, my total time period of future value is 2 years, not 4 period. So n is what? N is equal to total time period in years, and k, people in the class, is your compounding frequency. That is one second, that is number of compounding in a year. That is number of compounding in a year. Yes, people. So I wanted to make it very specific. Per annum, n is also per annum, like yearly period, and k is number of compounding a year, which makes the formula systematic and logical. Now any situation you will be able to answer it. Any situation you'll be able to calculate the correct future value. So I hope we are all set to that now. Perfect. Similarly, sir, calculating the future value if needed, how will you do it? Really simple. Let me do that for you right now. So kindly speed up now, people in the class, it's needed. So the point is, if you have 200 rupee here at the end of second year, if my compounding is, if you have, 200 rupee here. What will be the present value of that 200 rupee today? So as I said, there are two ways. You can say that present value is equal to future value divided by future value factor, or you can say future value into present value factor. Yes, sir, what is my future value? 200 rupee. How do you calculate future value factor? The same way. 1 plus r by k to the power nk. Or you can directly say 200 into what is the present value factor. So it is 1.05 divide equal is 0.823. 0.823. Now this is something I will have to explain to you. I mean, you may know it, but you should know what has happened. Do you know, in finance, whether it is this particular thing or it is CFA or it is financial modeling, anywhere, in CFA there is a different kind of calculator. Let me show that to you. Why feel bad? This is CFA calculator. If you observe the third row of this calculator, do you feel N, I by Y, PV, PMT, FV? You can directly do the future value calculation, complex to complex future value calculation directly on this calci. This is CFA calculator. So whether it is CFA calculator in CFA or this calculator in CA or excel in the financial modeling, sir, always the only thing you should know is that you should be able to talk to your calculator, talk to your device, talk to your software, which is really simple. Do you know, for a software, R is for a software, not for us, I am saying. For a software, R means what? R means rate of interest per period. For a software, for a calculator. For a software, for a calculator, N means number of years, no, number of periods. So that way, if you think, can I say there are 4 periods of discounting? And there are 4 periods of discounting, and rate per period is 5%. That way, if you have to calculate the present value, won't you do 1.05 divide equal 4 times? Isn't it 1.05 divide equal 4 times? So sir, that is how you do it. So I will say 1 plus 0.05 divide equal how many times? 4 times give you present value factor. So you have to understand what your calculator understand. R for a calculator is rate per period. N for a calculator is number of period, not per annum. The same thought process can be applied even here. So isn't it 1.05 to the power 4? So R is the rate per period of 6 months, N is the number of period. The same thing is happening, just that I wanted to also teach to you the formula, which is why we are doing it, right? So anyways, now when you have learned it, perfect. What is turning out to be the answer? 0.823 multiplied by 200 is 164.6. Those who already know it, are you people feeling it as a waste of time? Is it, people? Come on. Those who already know this concept, are you feeling it as a waste of time? What do you all say? Are we all set? Shall we proceed ahead? Now we're gonna learn annuity. This was calculating the present value and the future value of a single amount, either at the start or at the end. Now, if we have a series of cash flow, which means if you have annuity, for example, let me show you. Let me show that to you. Sir, if you have future cash flow, if you have zero cash flow, zero, 4 years. So if you have 200 rupee at the end of first year, 200 rupee at the end of second year, 200 at the third and 200 at the fourth, the question is how much is the future value of these 200 rupees at the end of fourth year is the question we are trying to answer. I mean, on your timeline, the imagination should be 100% clear that we are trying to calculate what we are trying to calculate. We are trying to calculate the future value of all these amounts at the end of fourth year. And similarly, we will then learn to calculate the present value of all 200 rupees at the start of the year, start of the period. So at least you should be clear with what your discussion is going on. I mean, the timeline imagination is really important. It helps you people understand what we have to calculate. So what my plan is, this future value calculation we will learn at a later point whenever it is needed. For now, let's learn the present value calculation, which is actually very easy. Can I say if I have to calculate present value, it is nothing but the annuity, which means the amount of cash flow. What do we call annuity? First of all, you have to understand. When you have the same amount of cash flow after the same time interval, 200 rupees received at the end of every year, at the end of every 6 months, then it is called as annuity. So if you have the amount of annuity and the present value of the entire annuity is annuity into present value annuity factor at the rate of 10% for 4 years. Here, if you observe, the present value factor or the future value factor was at the rate of 10% for 4 years. Here also it was at the rate of 10% 4 years. But you know what? There is something I can add to it. Out here, if you say, the future value factor people in the class was at the rate of, at the rate of 5% for 4 periods, not years. It was at the rate of 5% for 4 periods actually. This is what the difference is. Just give me a second. Did you observe it? Similarly, here also present value factor, if I tell you, it was at the rate of 5% for 4 periods. Done. But out here it is at the rate of 10% for 4 years, for example. Yes. How do you calculate the calculation steps? I hope you know. 200 multiplied by, how do you calculate annuity factor? Really simple. 1.1 divide equal 4 times if you do, and when you press GT, the answer is 3.1698. So which is 1 3.170 automatically gives you what answer? 200 into 3.170, 634 rupee on a rounded off basis. Sir, how did you calculate 3.170? Extremely easy, extremely simple. What do you say? Sir, it is like 1 plus 0.1, which is 1.1. Then divide, then equal to how many times? 4 times. And then you press GT. This is how you calculate the future value, present value annuity factor. Is this how you people were doing? Please say yes or no. So do you know what is the logic behind the GT function of the calculator, this particular function, gross total function of the calculator? Whatever number calculator calculates after pressing equal to button, all that numbers GT add up. For example, when you press 1.1 divide equal to, it is the present value factor of 1 year. When you press again equal to, present value factor of 2 year, then again equal 3 and 4 year. And when you press GT, it is adding up all the present value factors to make it the present value annuity factor, which is this particular number, because GD adds up on the calculator whatever comes after pressing equal to. People in the class, on this particular thing, I need a response. Could I explain to you? Are you people 10 on 10 settled? Requesting your responses. Super fast. Come on. Please speak up. Waiting. How much out of 10 are you people set on this? Waiting for your responses. Nagendra, 10. Archana, Yashwat, Priyanka, you want me to speak it once more? So Priyanka, that's really easy. I mean, you want me to explain the logic or the calculation? The calculation is really easy. 1.1, you take on your calculator, then you press divide. Equal 4 times, because there are total 4 discountings you have to do, and then you press GT. So it becomes 3.170 as the present value annuity factor. Logic you want to know. The logic is really simple. So 1 minute. So let me take a minute to explain to you the logic. Sir, do you agree 1 rupee of first year end will be 1.1 divide equal to, it is 1.1 divide equal to, do you agree it will be 0.909? 1 rupee of here today will be again pressing equal to, which is 0.826. Then 1 rupee of third year is again pressing equal to, on my calculator is 0.751, and 1 rupee here is again pressing equal to, which is 683. And annuity factor, do you agree, is nothing but the sum of all these present values is the annuity factor. This is what I have to logically do, Priyanka. Right? So I have a limit of how much I can deep dive into the logic, but still I'm trying to explain to you, right, at a further depth. So annuity factor is nothing but sum of all the present value factors of future years. So basically what you have done is 1.1 divide equal to gives you 0.909, again pressing equal to give you 826, again pressing equal to give you 0.751, again pressing equal to 0.863. And now I have to sum them all. So what can I do? GT function on the calculator adds up all the numbers which you have calculated after pressing equal to. So after pressing the first equal to, I got this, then second equal to, I got this, third equal to, I got this, fourth equal to, I got this. So adding up all means pressing GT button will automatically give you the summation of all of them as 3.170. Could I explain it to you now, Priyanka? Joshua, what you're saying is absolutely correct. When you press 1.1 divide equal to, you are actually saying your calculator to do 1.1 divided by 1.1 is equal to. When you say 1 divided by 1.1 equal to is the same number as 1.1 divide equal to. Yes, so anyways, I think we are all clear. Sir, now annuity due part, if needed, we will do it, but in my understanding, we won't need it. Then do perpetuity. Sir, let me explain to you what are these two situations here. Regular annuity means when the cash flows are towards the end of the year. Same will be annuity due, sir, in which 1, 2, 3, and 4. The cash flows are assumed to be at the start of the period. This is first cash flow, second cash flow, third cash flow, fourth cash flow. I just want you all to know the difference. That's all. Assume the cash flow at the end of the year. Period assumes the cash flow at the start of the period. That is only the differences. If we don't want to learn the maths here, we just want to learn the logic here. The timeline imagination here, sir, then is perpetuity, which means if I assume the cash flow not for a particular period but for infinite number of years, then for those infinite number of year of cash flow, can we calculate the present value, people in the class, as we were doing? The answer is no. Answer is no. Not possible. Meaning to say, suppose if you receive 200 rupee for infinite number of year, what will be the future value of that? What will be the calculating the future value, people in the class? I think by mistake I said present value. Point is, for an annuity, the future value calculation is impossible, because 200 rupee after infinite number of year will become an infinite amount which cannot be calculated, but present value can be calculated, which is really simple. Sir, present value of a perpetual annuity, infinite annuity, is nothing but annuity divided by rate. So 200 divided by 10% give me rupee 2000 as the present value. Yes, boss. So A divided by R become the formula of calculating present value of perpetual future annual cash flows. Oh, my bad, my bad. Thank you so much. Thank you so much. I will rectify it. Yeah. My bad. I have rectified it to write it down at the right place. Yes. Sorted. People, this was learning about the time value of money calculations that we will have to do in the chapters ahead. Guys, at this particular point, I just need a minute to talk to you, because now onwards we will proceed to the first chapter. Actually, the other basics we will learn over the time. That is the advantage of outnotes. You know what? Practically, if there are no outnotes, listen to me, what happens if there are no outnotes? If I make you people create your own concept notebook right from the scratch, a simple plain notebook like this, a plain notebook like this, what will you do? We will end up writing some basics, right? And do you agree, all the basics, even if they are not relevant right now, we will have to write down right now only and then start with the chapter, because that's how all the basics will be compiled at place. But that is not the situation for you, sir. For you, the other basics which I know will be applicable to you, but not on the first two chapters, we can do later, right? For example, other basics which will be applicable to you, but not that you need to learn them right now, we can do them later. So that way, if the outnotes are already organized, pre-structure, we can learn it at our convenience, but later on, at the time of revision, you will find everything in a perfect sequence. The classes will get over in the next 2 to 3 months. What will remain with you is the book that you have in your hand right now and the learnings in your brains. This might fade up with time, obviously, which means all you will have is the book to refer to. So you have to realize how perfect that thing should be, which is why this concept of pre-structured notes. Is it a sensible idea, people, according to you? The way we are learning things, is it making sense? The way they are structured, the way we are proceeding ahead. I mean, we have started to use the outnotes. Are you liking them? Are you finding them more sensible? What do you all say, people in the class? All the recorded people, live people, literally. Recorded people, literally, you'll have to respond to this. Because as I said, every line, every box, this is still a simple chart, but every damn presentation, every color that has been chosen, every box, imagination, line, everything, sequence is done by me personally. Meaning to say, your suggestions, your feedbacks can help me to improve them significantly. This is already a 10th version at least of this out notes. Every time I end up doing something in it to make it better. Yes, others in the class, what do y'all say? So, recorded people, it's your responsibility to give me that feedback of how do you find the out notes. Yes, maybe in the comments or something. Live people, are we all set? Are we all ready? Are we all liking the approach? Can we all now proceed finally to get to the first practical chapter, which is equity and business valuation? What do y'all say? Are we all excited to finally get into CA final and learn the things? Yes. So far, we had been revising only the things that you've learned at CA interlevel. Sir, equity and business valuation chapter being the first chapter, as I said, was actually what? Sir, business valuation is chapter number 13 of the study material. Sir, equity valuation is a part of the chapter 5 security valuation. The two collectively are to be done as equity business valuation. We do them collectively because the thought process needed for both of them is same. So starting with the equity and business valuation, now I'll tell you the next thing about outnotes. Before almost all the chapters, you have a flow of the chapter, that what all does that chapter have, like this. So just give me a minute, let me have water, then I'll continue to speak. Just give me a minute, please, everyone. Yes. So what were we saying? This chapter actually will teach to you valuing. Sometimes the equity share of a particular company, that for a particular company, the equity shares which are being traded in the market, or even if it is they are not traded, they must have some value. Yes, sir, they have a value called as face value. Oh my God. Face value is just a number written on the share certificate. The actual value means when I sell that share to you, how much amount will you pay to me is its actual value. Or you should pay to me at least is its actual value. Similarly, sometime the entire business as a whole, how much should be the value is what you will learn in this chapter. Perfect. Sir, there are different ways or approaches to value. We can value a company based on the dividends that company distribute, sometimes based on the cash flows that company generates, or the assets that company has, or the earnings it makes, or relative valuation is one more method. So these are primarily five methods, five broadly approaches to value a company, just five. And then are other important topics related to this particular chapter. So let's start with the first way, first model, dividend discount model, dividend valuation model. There is a fundamental rule, everyone in the class, I want to teach you. What is that rule? The rule, fundamental principle, of valuation says that value of an asset today is the present value of whatever future cash flows that asset will generate. Whatever future cash flows an asset will generate, the present value of all those future cash flows today is the value of asset for me today. That is the fundamental rule I want to explain. Everyone, could you get it? Which means if you talk about purchasing a share, when you purchase a share today, what are the future cash flows you will generate? Sir, so long as I will hold the share, I will receive dividend. And then whenever I will sell the share, I will receive the selling price. So present value of all those future dividends and that future selling price is the value of share for me today. Similarly, when I go to the market to purchase a bond, if you purchase a debenture, a bond, a fixed income security today, what are the future cash flows you generate? Sir, when I purchase a debenture today, I will get future interest amounts and I will get the redemption value of the bond. So present value of all these future interest and the redemption value is the value of an asset today. Could I explain to you such a simple fundamental rule of valuation? What it says? Sir, when it comes to equity share, the value of share is nothing but present value of dividend plus the sales price of share. Broadly thinking, present value of the bond today will be present value of interest. Do you know what is interest officially called as? Interest amounts are officially called as coupons, plus the redemption value, or for any other asset, present value of future cash flows is the value of asset. Present value of future cash flow is the value of asset. Are you people please realizing it? Yes, basic. You would want to know, do you agree with the logic? First of all, do you understand the logic? Answer my first question. Mostly yes. Do you know the logic behind this logic? Logic behind this rule, logic behind this principle is a real common sense. Let me ask you that common sense. Sir, suppose you want to, suppose I tell you, I'm trying to explain to you the underlying common sense. Suppose, boss, this is 0 year, this is 1 year. You want to make an investment in an asset for a period of 1 year, and you know the asset is going to give you 110 after a year. My question to you is, how much should you invest in that asset today? How much amount should you invest in that asset today? If I say you should invest 110, will you agree to me? I ask you to invest 110 in an asset today. After a year, you will get 110 out of it. Please answer my question. Will you invest, yes or no? Come on. Think your answer. Will you invest, yes or no? All the recorded people, when I say answer this question, at least in your mind, you should have the answer with you. You may not be able to give it to me, is fine. But if you don't have an answer, then you're not evolving yourself actually. When I said I will evolve you, how will that happen? Every time there is a situation, I'll ask you a question. For that question, if you think an answer, you're evolving. So you will not invest because you're not earning anything. Sir, next situation. I am asking you to invest 105 in that asset and you will get back 110 out of it. Are you fine investing now with it? Quick answer, yes or no. Quick answer, yes or no. Are you people fine investing with now? Some people say yes, some people say no. Those who say yes, they are happy that I will make at least 5 rupee as the return. But those who are not happy making 5 rupee return, they are saying no. They say that, sir, we are ready to invest 100 rupee. Why? Because when we invest 100, we will make 10 rupee of return out of it when we get 110 back. Because when you get 110 back, the original 100 rupees against the principal, but the extra 10 rupee is your return. So if you observe, to find out the amount you are ready to invest, what are you doing? You are basically doing a back calculation. You are figuring out that in my 110, which I will receive after a year, how much is the return I am ready to earn? I want to earn. I require to earn. Listen to my line. In this 110, how much is the return I require to earn, the minimum return I need to earn? Sir, if it is 10 rupee of return, you are ready to invest 100. Someone minimum wants to earn 15 rupee of return, he will be ready to invest only 95 and so on. Could you understand my point? What you do? In the future value, eliminating the return you want to earn and arriving at the principal that you are ready to invest. And let me tell you, in finance, how do you eliminate the return? How do you eliminate the return? Sir, you eliminate the return by discounting the cash flow. How do you eliminate the return? In this 100 rupee, which includes the present value plus the return element, this 110, which is my future value, which includes the component of present value and return element both. Sir, if you people in the class discount it, if you do present value, what you are effectively doing is eliminating return to calculate present value, which can be invested. Sir, when you divide 110, suppose you want to earn 10%. Suppose you are satisfying by earning 10%. So do you agree 110, when you discount using 10%, which is 1.10, you calculate 100. So what you have done here, you have done nothing but eliminated the return component to calculate the present value, sir, which will turn out to be 100. So isn't the logic, value of an asset today is the present value of your future cash flow, because future cash flow has the element of original principal as well as the return. So if you eliminate the return which you want to earn, you can find out the amount of investment which you can make. Are you people agreeing now to this logic, this fundamental principle of valuation? Please everyone, I need a response particularly on this thing. How much out of 10 I can explain it to you? Come on, tell me. Please. Waiting for your responses. Eliminating the return. Let me mark it with better word. Eliminating return to be earned. Yes, take your time and respond. If you don't respond to me, I'm not going to go ahead. You don't have to always say yes, that sir, we got it. If you didn't get it, you have all your rights to ask. But you will have to respond, that is a for sure thing. you will have to respond. That is a for sure thing. What I was trying to teach to you? That randomly on a day when I come to you, that value of an asset is the present value of future cash flow, you'll be like, sir, how did you come to the valuation? How many of you know valuation is particularly sometimes a job profile? Valuation particularly is a job profile that you have to do in the real world. When you enter into a company like a startup, you have to do the valuation of the startup. When you enter into an investment banking profile where the companies come up with their IPO, so you have to do the valuation of those companies before they come up with an IPO. When I do equity research, I have to value a company to figure out if the company is overvalued or undervalued. Correct? Valuation is a profile, and that highly paying profile has a simple formula. Value of an asset is the present value of future cash flows. Are you people realizing? That is actually the logic, the formula, the principle, and that is what I am trying to explain to you, the underlying logic. I didn't answer it. So first of all, how many of you think that I should repeat this concept? How many of you feel that I should repeat that concept? Please tell me. Either you have to say yes, we are 10 on 10 sorted, or you have to say, sir, please repeat the concept. One of the two things you will have to say. Everyone waiting for your responses super fast. Please. Let's be really quick. Everyone in the class. I tell you a simple thing that you have an opportunity to invest in an asset which is going to give you 110 after a year. Yes. I am asking you how much can you invest in that today? Are you ready to invest 110? You said no. Are you ready to invest 105? Those who were fine earning 5 rupees, they were fine, right? Sir, they were ready to invest. I am say, are you ready to invest 100 rupee? So those who were ready, those who were okay earning rupee 10, they were ready to invest 100. But now suppose you want to particularly earn 15 rupee. In that case, how much are you ready to invest? Sir, 95. Because common sense is really simple. If you receive 110, in which you want your return to be 15 rupee. So the balance that you are ready to invest today is obviously 95. So can I say the amount that you are ready to invest is nothing but eliminating the return component from the future value that you will receive. Logic. Eliminating the return component from the future value that you will receive automatically give you the present value that you should be ready to invest. So sir, eliminating the return component is nothing but discounting the future cash flows, calculating the present value of future cash flows. How many of you know that discounting something is nothing but eliminating the return component? Sir, do you understand this simple logic that present value plus interest is equal to future value? So when I say add interest to the present value, it is called as compounding. But when I say calculate the present value from the future value or eliminating the interest, see, how do you calculate present value? So basically future value minus interest is the present value. Eliminating interest, deducting interest, and that simple process, people in the class, is called as discounting. Now people in the class, could I make it 10 on 10 clear to you all? Please tell me. Now could I make it 10 on 10 clear? Please tell me. There's some student Priyanka. I am all fine getting your feedback. Can you please, Priyansh, sorry, Priyansh, can you please share your details to me on the WhatsApp number? It is 7045748955. But make sure that you're not a fake student just trying to be here on the YouTube live and distract others. You will have to be fair. In fact, I would ask you to do it in the next 2 minutes if you're listening to me. Okay, your serial key, your registered number. I'll 100% help you with your issue. Okay, cool. Perfect. So, sir, we are now proceeding ahead. Or also are 10 on 10. Perfect. So, sir, this way, this is the fundamental principle of valuation, which means that even if you work at that level, even if you work at corporate, to value a company like Reliance, is the underlying logic same? The answer is big yes to it. Forget a share if you are valuing the entire company, Reliance Industries, right? The underlying logic of valuation will remain the same. The present value of future cash flows the Reliance will generate will the value of Reliance Industries today. Perfect, perfect, fine, sir. If you do the valuation, suppose we have done the valuation, do you know the value that you arrive is not called as the market price? People, the value that you arrive is not the market price. The market price is already there in the market. Then what are we calculating? The price is already there in the market. That is the price. What we want to calculate is what should be the price, what should be its true value, its true worth, its intrinsic value, its fair value, its equilibrium value is what we calculate, and what is the price actually there in the market is there. Which means, for example, for a share of TCS, I know the market price per share. The market price per share of the share of TCS is 3300. When I calculate the intrinsic value, when I apply the valuation formulas and everything, I end up arriving at the value of share according to my calculation as 3000. Which means when MPS, for example, 3300 is more than the intrinsic value of 3000 according to me, what do you call this situation? If the price of the share is more than how much it should be as per my calculation, we call the situation to be overvalued. I mean, we will learn to do the valuation, but before learning to do the valuation, I'm trying to teach you the application of it, that after doing valuation, what do? You take the decision actually. Action, or I can say decision. Perfect. That if something is overvalued, we have to sell that particular thing. If market price per share is less than the intrinsic value, price actually there in the market is less than how much it should be, then we call the thing to be undervalued and we should buy such share. And if the price in the market is equal to the intrinsic value or fair value, means it is equal to how much it should be, then you call the share to be fairly valued, and theoretically you hold a fairly valued share. Theoretically, in the practical world, you buy that share actually. Logic is really simple. According to me, the value of a share is 3000. According to me, the value of a share should be 3000 and its price in the market is 3000. So it's good, now you're happy about it. It is what you want it to be, then you end up buying it practically. But theoretically, we say it is a hold. People, this is the application of calculating the value, intrinsic value. It is the application of valuation. Now, let us proceed to take a break. After the break, we will learn specifically that, sir, this intrinsic value that you've talked about, whose fundamental principle is present value of future cash flow. The intrinsic value, which is ultimately being compared with the MPS and then figured out whether we should buy or sell or hold. How do we calculate that intrinsic value? That is what we are going to learn after the break. Everyone, are we all set to take a break? Are we all set to take a break? What do you all say? Yes. So, let us take a break. It is 9:46 right now. Let's meet back at 10. All right, people, let us meet back at 10. So I'll see you all at 10. Please be back. And then when we continue to learn specifically the things for valuation. Yes, bye. Yes, there everyone back, please. Are we all people? I was just wishing the students all the very best for the exam. But it was quite a few in Hindi, so there's a possibility that you could not have got it. People, are you all there? Back, please. Do you know what did I say in that message? Quick one-liner. I said irrespective of the efforts that you will make throughout these 4 months, throughout these 3 years, the level of CA final exam or maybe the psychological fear of CA final exam is such that you end up ultimately concluding that I may not be able to make it. So one side is the efforts you have made throughout, which can give you confidence, and another side is the fear of the exam, which make you people forget that efforts and make you people and feel underconfident about your score, about your results, about your present performance in the exam. So just wanted to make you people just wanted to remind you people that the level of efforts you have made is significantly bigger, higher, impactful than the level of exam. So don't let that fake fear dominate your real confidence, is the point I wanted to make. The fear at this moment is fake and the confidence you actually have is real. Don't let the fear dominate it and then go for the exam. Do you all agree to what I'm saying? Everyone. Only if you understand it now, you'll be able to understand it one day before the exam. Because right now you just have to use your logical brain. You don't have any fear of that moment which is dominating your confidence. Right now you may find logical, whatever I'm saying. But on a later day, when that fear dominates you, that is when you would actually need it. Yes, people, so let's get started. Trying to specifically start with dividend valuation model, right? Dividend valuation model says the present value of any share, sorry, the value of any share is the present value of future cash flows. Perfect. Sir, there can be two possibilities that you can face in the exam. I may be holding a share for some particular number of years, some definite number of years, or I may be holding a share for indefinite, or I can say infinite number of years. For example, I am holding the share for 5 years. So let's imagine, let's apply common sense. Suppose I am holding a share for 5 years, which means at the end of 5th year, I will sell the share. So what is the present value of that share today? Sir, whatever amount of future cash flows, meaning to say whatever is the amount of dividend for the next 5 years, plus the selling price at the end of 5th year, present value of all these future cash flow will be the value of share, meaning to say present value of dividend of 1 year, 2 year, 3 year, that way till nth year. Whenever I end up selling, it is nth year. So present value of dividend of all these years plus the sales price and sales price, or I can write it as plus the present value of sales price of nth year the better word is selling price actually. Become the value of share today. How do you execute it in the notebook that we will learn? But it is a very simple thing, the present value calculation. For your imagination, if I have to give you the format, sir, 1, 2, 3, 4, 5 years of cash flow. Every year I have some dividend. 5th year I have dividend plus the selling price. If these are my future cash flow, how you discount them? If these are my cash flow, let me multiply them with the present value factor. Can you please recollect something from C enter? Right? Cash flow multiplied by the present value factor give you the discounted cash flows, and that discounted cash flows total will be the value of share today. Sir, it is nothing but the present value of dividends you receive till you sell it and the selling price at the end of the period. Yes. That is how it is. Let's proceed ahead. We will learn the specific applicability of it as we go to the practical question. But for now, are you people sorted? Please tell me. In the meantime, I'm taking a doubt. Super fast, everyone in the class, such a basic thing. Sir, what have you written here? I have written P0 is price at 0 point or IV0 is intrinsic value at 0 point. Sir, what we calculate is intrinsic value, but what is there in the market is price. Agreed. So now you have to understand one more thing. Sometime institute calls the market price to be the only price, which is P0. What we calculate is intrinsic value. If I assume the share to be fairly valued, sometimes institute assumes the share to be fairly valued, and that is when it says that price and intrinsic value are equal to each other, which is why it ends up using these two words interchangeably. Sometime it says price, sometime it says intrinsic value. So any of these two words may be used, but the logic is really simple: present value of dividends and cash flow, the selling price, which is computed by multiplying the present value factors to these cash flows. People, I need a response at this point. Are you people please settled? Kindly give me a response. Archana says capital gain is also a return of the share. Why is not that considered? People in the class, Archana is saying, so I'll repeat your doubt with everyone, but others in the class kindly respond to me with this so that we can do an illustration. I mean, everyone, you have to realize that your responses really, really matter. Based on how you respond, my way of explaining depends. If you understand everything, but if you don't respond, I will feel that you didn't understand and I'll end up repeating everything twice, thrice, which will waste your time. If you don't respond and if I assume you got it, I may not repeat it, but it may happen that you actually didn't get it. You will end up losing the concept. So your response is really important. So please tell me, if you say, sir, we didn't get it, we do the illustration. If you say, sir, we are broadly comfortable, now we'll see it in the practical question, we can skip this illustration, is the point. So super fast, your response is needed. Every single student sitting in the class, recorded people, please. Archana, in the meantime, your question. Archana says, sir, capital gain is really important. For example, I purchase a share for 100 rupee. After 5 years, I sell it for 150. Along with that, I receive the dividends at the end of every year. So present value of future cash flows I need. Archana, my question to you is, what did I say to you as the rule? Present value of future earnings or present value of future cash flows? I said present value of what all you will receive in future, what all you receive as cash flow. So I will receive these dividends as the future cash flow. Also, I will receive this entire amount of 150 as cash flow and not only the amount of 50 rupee of my capital gain. Do you agree 150 automatically includes 50 rupee of capital gain in it? So I will have to consider the present value of future cash flows and not just the present value of capital gain. Are you sorted with it? But I appreciate that you thought, because it is only when you think you evolve. Yes. So sir, this is the thing. There is an extremely easy illustration which I create people who find it really hard. For now, we seem to be sorted. And as we go to the practical question, you'll learn it more. Sir, now if there are if there is an infinite holding period, I don't know for how long will I hold the share. Is it for 5 years, 10 years, 15 years? I don't know. In that case, you calculate the value of share today. The price or the intrinsic value today is the present value of future dividends. Right from dividend of 1 year till the dividend of infinite number of years, whatever dividend I will receive, I discount all of them to 0 point. So calculating the present value at 0 point of all future dividend will be the value of share. Yes. So now one more thing. Sir, what is the rate of discount being used to calculate the present value? Sir, the rate of discount is the required rate of return. How much rate I require to earn is the discounting rate. For example, those who wanted to earn 15 discounted using 15. Those who wanted to earn 20 discounted using 20. So discounting rate is the required rate of return, and the required rate of return, people in the class, you should know, is called as KE. The required rate of return for equity is, everyone in the class, called as KE. Agreeing to it? And now you would be able to connect it to something in the basics I have taught. Let me connect all the dots. I taught you that what you require to earn is eliminated. What you require to earn is eliminated from the future value. Eliminating is nothing but discounting the future value so that I can come to the present value. Which means for discounting, what is the rate being used? The what I require to earn is being used. And now if you realize that is specifically mentioned in the basics, please observe that is specifically mentioned that required rate of return is being used as a discounting rate, because discounting is eliminating the required income. Everyone, could you connect to the dots I was trying to explain? I am trying to explain. That is why we specifically said that required rate of return is used as a discounting rate. Everyone, could you connect that dot? Please respond to me. Because the rate at which you require to earn the income, that is the amount you eliminate, that is the amount you discount. Everyone, could you connect? First thing. Second thing. So we know that we need a required rate of return for discounting. The required rate of return that equity shareholder want to earn is called as cost of equity, is the second thing. Third thing, just repeating what I explained, if you have limited a particular life known, so cash flows you are getting during that life is what you discount. So dividend till that point and the selling price at that point, selling price of n point and dividend till n point is what you need. And sir, if the holding period is not known as infinite, then present value of all the dividend from year 1 to infinity discounted at the rate of k is the value at 0.10 on 10 on this particular thing, please. Everyone, what do you say? So sir, if I have to do this, it's all easy. I can manually discount. But please imagine, if something is for infinite number of years, can you discount it? Meaning to say, suppose I'm planning to hold the share for 3 years. So dividend of first year is 10, second year is 12, third year is 15, and the selling price at the end of third year is 300. If these are the cash flows, you can discount it for 1, 2, and 3 years respectively. However, let's imagine that you have to discount the dividend till infinite year 10, 12, 14, 19, maybe again 20, then maybe 18, 25, that way. You have the dividends till infinite number of year. Can anyone in the class think how will you discount something that goes till infinity? Can anyone in the class think how will you discount something that goes till infinity? Is it manually possible to do? What do you all think? Everyone, waiting for your responses. Only when you think you evolve, which is why I want to make you people understand it. Think it. Try to answer it. Do you realize the problem? First of all, how many of you realize the problem? I'm not expecting the solution, but how many of you realize the problem? Yes, sir, that we got a problem. The problem is that cash flows are till infinity. The problem is that we don't know how do you manually discount something that goes till infinity. Do you realize the problem at least? First step. Forget solution. The solution, people in the class, I will speak of if you say, sir, problem we are agreeing to. The solution, everyone in the class, is simple, which is nothing but calculating the present value using the logics of perpetuity. Sir, you have to make use of, we have to make use of mathematics now. We have to take the help of mathematics. So, sir, we will use dividend discount models that we will learn ahead, which are based on maths, which help us discount the present value of future in finite number of years of cash flows. That is what the dividend discount models will be of help, which we will learn later. But before that, let us try to learn that if I need KE as the discounting rate, how do we calculate that KE? Are you all aligned? What is going on? I said there are two possibilities to discount. Fine. In both of them, you need a K as a discounting rate. So cost of equity, which is nothing but the discounting rate to be used, which is nothing but the required rate of return of the equity shareholder. That is what we will learn now. Are you people settled with the flow? So guess, Archana, that you have made is correct. Perpetuity is the logic using which we will do the discounting. People, requesting your responses. Are we settled? Do I have the permission to go ahead? Is what you will have to answer. Come on, super fast. If you say yes, we proceed. If you say no, I will take your doubts. Come on, come on, come on. Everyone super fast, please. Harshita says yes. Priyanka says yes. Others, what do you all say? Archana, the knowledge you had out there at CA inter level was actually limited. Sir, how can we assume KE as my required rate of return? Has a really simple answer. I mean, it is a fact. How do I explain that to you? It is a fact that you are an equity shareholder. Archana, that's not a problem. If you are an equity shareholder, when you give me money to me as a company, you are expecting some return in return, right? Whatever return that you want to earn is a cost to me, is simply the cost of equity. So required rate of return actually has two perspectives. Now when you ask me a doubt, let me answer. It has two perspectives. One perspective is required rate of return, which I explained. Opportunity cost is automatically a required rate of return. For example, you are a person, you are an investor. You have two choices. You can invest in my company, or you have a choice to invest in some other company, say for example Reliance. If you invest in Reliance, then suppose you think you'll be able to earn 15% rate of return if you invest in Reliance. Perfect. So do you agree? Assuming my company and Reliance has the same risk. So what is your thought process right now? So your thought process is, since both of us have the same risk, you can earn 15% by investing in Reliance. So isn't that 15% should be the same rate of return that you would want to earn from me? Because you have a choice to invest your money in Reliance. Now you would want to earn a same return from me. So automatically the opportunity cost, that 15% which you won't be able to earn if you invest in my company, that opportunity cost becomes your required rate of return for me. Do you understand, Archana? Could I explain that to you? But whatever you require to earn from me become a cost to me as a company, calling it to be the cost of equity. Could I answer your question that how is required rate of return is ultimately a kind of opportunity cost? Yes. Others in the class, could you understand her question and the answer? That how is opportunity cost and the required rate of return linked to each other? Because what you lose somewhere is what you require to earn here. So automatically that opportunity cost that you're not able to earn become the return you want to earn here, become your required rate of return here. Perfect. So anyways, sir, how do you calculate cost of equity? In your entire AFM, there are three ways you can calculate cost of equity in the particular sequence. The most logical way to calculate the required rate of return is CAPM. How many of you have learned that as per CAPM, the cost of equity is RF plus beta into RM minus RF? Such a logical formula. Have you all learnt it at C enter level? Yes. The entire depth and logic of it you will learn in the chapter of portfolio management. For now, it is sufficient for you to know that CAPM, this equation which you have already read at C enter level, is one of the ways to calculate KE. Sir, can you help us individually know what individual things are? Yes, very well. Sir, RF is what? Risk-free rate in the market. Sir, how do we get to know the risk-free rate? It is government bond yield. Sir, can you explain it a bit? Yes, let me explain. You have a choice to lend money or to invest money. Option 1 government, option 2 me. One option is that you can give the money to RBI, another option is that you would give it to me. Please tell me in which of the two cases you feel less risk. People, in which of the two scenarios you feel lesser risk? To government, lending to RBI, lending to government, investing in RBI's bond, you feel lesser risk as compared to giving your money to me. But practically, literally, it is otherwise. You have paid your money to me to learn from me. Well, the context is different, but I get your point that you don't trust me, right? Which is very genuine. Why? Because I don't have a printing machine which government has. The money that you give to the government is theoretically considered risk-free. So when you invest, there is no risk. So the rate of return that you earn from that security is considered a risk-free rate, that without taking any risk an investor is able to earn that amount called as risk-free rate. Sir, then is return RM. That is return from market. RM is market rate of return. Can anyone in the class try to guess what is market rate of return? The rate of return which is being earned in the market. Which market we are talking about? So stock market, equity market, NSE, BSE is what we are talking about. So what represents your market? Sir, NSE, which is National Stock Exchange, is represented by its index called as Nifty. BSE, which is Bombay Stock Exchange, is represented by its index Sensex. So Sensex moving up is a kind of market moving up, Nifty moving down is a kind of market moving down. The return of stock market of NSE can be figured out, can be calculated using the return of Nifty. So market rate of return, sir, is somewhere represented by index. Market rate of return is represented by index. And sir, what about beta? Beta tells you the risk. Beta tells you the risk about which the detailing we will learn in the chapter of portfolio management. Beta tells you the risk, right? Rest of the details in portfolio management. Details in portfolio management chapter. But do you remember yesterday we talked the required rate of return depends on the risk you take. Y'all people said that in Bitcoin you need a higher return than FD because Bitcoin has a higher risk. So higher is the risk, more is the return you want. And please observe automatically in the formula of required rate of return, risk is automatically a component. Are you finding the things aligned? People requesting your responses, please tell me. Are you finding the things aligned? Yes. Sir, few more things to learn. Do you know what is RM minus RF called as? RM is the rate of return you earn in the market. RF is the rate of return you earn by investing in the risk-free security, right? RM minus RF people in the class is called as market risk premium. Sir, the word risk premium is not risk. It tells you the extra return you earn when you invest in the market as compared to a risk-free security. The meaning of that is more important. The extra return earned the extra return earned by investing in market or index as compared to risk-free rate by investing in risk-free security. Do you people feel bad to be able, because of not having this technology with you, that you can also write like this? Are you finding the things crystal clear? That's really important. I mean, both the things are equally important. Terminology is important. It gives you the help you solve the practical question, but the understanding of that is also important. It helps you to understand what is going on. So RM minus RF is the market risk premium. There is one more thing I want to teach you, which is security risk premium, that you will learn in the chapter of portfolio management. In detail, we have a specific topic called as CAPM. Out there we will learn everything. For now, this is sufficient. Sir, this is first way to calculate cost of equity. If data of RF, RM, beta, anything is not there, and then also you have to calculate cost of equity, then there is another way. That is your second preference, called as Gordon's formula. And all that against you have learned at C enter level, that sir, cost of equity is nothing but D1 divided by P0 plus G. How many of you believe that yes sir, we have read it at C enter level? Come on. We have read it at C enter level. How many of you believe that? Everyone, what do you say? Do you remember any such formula? That if this data is not there, this is another way to calculate the required rate of return. And sir, third possibility, if even this is not there, then third possibility is earnings yield. What was dividend yield? DPS divided by MPS. Earnings yield, people in the class, is EPS divided by MPS. Oh my God. As I said, yield is return which is always calculated based on market price. If you feel like writing it, you may write it down. Yield is a return which is calculated based on market price, whether it is DPS or EPS, like whether it is dividend yield or earnings yield or whatever. Perfect. So EPS divided by MPS is the earnings yield, will be the last preference for us to calculate K in the entire AFM whenever it is needed. People, isn't it like the formula of PE only? Is it that earnings yield and PE are the same? How many of you feel so? That earnings yield and the PE are same? Is it? Sir, not really. In fact, PE ratio is opposite of earnings yield, which means next formula automatically become 1 divided by PE ratio to calculate earnings yield. That is how you calculate it. Perfect. Now one particular thing I just want to tell you, the explanation of which 100% guarantee will happen in the chapter of portfolio management. Sir, when do you know what is the difference between required and expected rate of return? Yes sir, required is how much I need, expected is how much I think I'll be able to earn. Similarly, price is what is there in the market, intrinsic value is what I think the price should be there in the market, what is its true value. Listen to a conclusion. The logic, we won't discuss it now. Simple. Sir, if the required, sorry, if we assume the share to be fairly valued, which means if we assume the price of the share to be equal to its intrinsic value, then in that case, people, the required and the expected rate of return will be same. What I require to earn will be same as what I think I'll be able to earn, or I will be able to earn the same as what I require to earn. Other way around if I speak, sir, this is a mathematical concept that you should understand. Finance concept that you should understand. Sir, what is the underlying logic? If you allow me, we will do it in portfolio management chapter, because if we do it now, it will end up taking more time, which is not needed, because we are anyways going to cover it later. Similarly, we can think it otherwise, that if the required and expected return are same, for example, in a security, I want to earn 15%, and I guess I'll be able to earn 15 only. Then it means that its price which is there in the market is surely equal to its intrinsic value today. People, this is a relationship you should know. But sir, why are you telling us that relationship? Because sometime institute ask you price, sometime institute ask you intrinsic value. Don't get confused that sir, price is actual, intrinsic value is what we calculate. So how can I tell him the actual price? You have to simply calculate the present value. He may uses the word interchangeably. I need required rate of return for discounting rate, but sometime examiner give me expected rate of return. Can I discount any cash flow using expected? Logically, no. I can discount any cash flow only using required rate of return. But since the two returns are interchangeably used, I have to use the given expected rate in the question as the discounting rate and calculate the present value, is what I'm trying to tell you. Could I please, people in the class, convey to you everything that I tried to speak on this particular page? Kindly respond. Please speak up. Please speak up. What do you say? Waiting, people. Could I explain everything? Set are we all on this, people? Are we all really set? Come on, people. Come on. Is it all sorted for the day? I mean, for this topic, not for the day. Any doubts you may ask? If no, we proceed ahead. So, except for the things that you will learn in portfolio management, like the detailed logic of this equation, like the logic behind using intrinsic value and current market price interchangeably, the logic behind using required and expected rate of return interchangeably, we have learned everything out here. Perfect. Fine. So now we finally say, how do you apply the dividend discount models? These dividend discount models, how do you apply? So it actually depends on the nature of cash flows. Sir, possibility one. The cash flows are constant dividend cash flows, zero growth cash flow, as both of them tell you the same thing. I will receive the dividends till infinity. But if I observe the pattern of dividend, the amount of dividend every year is same, constant. The amount of dividend has zero growth. They are same every year. Can you please try to imagine a situation that till infinity I have same amount of dividend to be received? The underlying logic says the present value of future cash flows, the present value of future dividend till infinity is the value of share today. In that case, can you please try to figure out, can you try to create the formula at your own, that how do you calculate the present value? People? Just give me a second, it got misbalanced. Yeah. Priyanka, I'll come to you, Priyanka. In the meantime, can you try to please create the formula at your own? You know the logic. Try to think that if I receive the dividends till infinity, the same amount of dividend, how do you calculate the present value? People, do you all agree? The same amount of dividend, same amount of cash flow is annuity. And if it is received till infinity is perpetuity. Have we all learnt in the class? Calculating the present value of perpetuity? Yes, sir. We have learnt the formula. It was A divided by R, if you remember. For us, what is the A? What is the amount of annuity? The amount of annuity means the amount of dividend. And what is the R? The discounting rate K. So can I say people, can I say the present value at 0 point or the intrinsic value, sorry, the price at 0 point or the intrinsic value at 0 point is nothing but D divided by KE. D divided by KE. Perfect. Point of detailing. Sir, I should specifically say D1 divided by KE actually. Sir, why D1? Why dividend of first year? All the dividends, if are same, for example, this is 0 year, this is 1 year, this is 2 year. Till infinity, if all the dividends are same, how does it matter if we take D0 or D1 or D2? How does it matter? Mathematically, the answer will same, but logically you should understand that this particular formula is discounting what? It is discounting your future cash flows. Future means right from the dividend of 1 year till the dividend of infinity. All the dividends are being discounted, meaning to say dividend of 0 year is not being discounted with this formula is the point of observation. What is this formula doing? This formula is calculating the present value at 0 point, but discounting which all dividends? Right from dividend 1 till the dividend of infinite years, it is discounting. But please observe, it is not discounting the dividend of 0 year, it discounts the future cash flows, not the present cash flow of dividend of 0 point. People, am I able to deliver to you the clarity? Sir, for your information, for your future reference, you may write this formula will give you present value of D1 to D infinity and not D0. Just for your ease, for your reference, if you feel like writing, you may write down. It's optional, it's a choice. But this clarity of concept, this small formula has this clarity which will be of use at some point in the practical question. Sir, similar to this, sir, if the dividends have a growth, if we don't have the same amount of dividend every year, if the dividends have growth, but a constant growth, which means 5% of growth every year till infinity, is it possible, sir, to discount those dividends till infinity which are constantly growing? The answer is yes, there is a possibility. Yes, sir, what is the possibility? Can you all please help me to think the Gordon's formula? Yes, sir, Gordon's formula say P0 or intrinsic value at 0 point is nothing but D1 divided by K minus G. Can I say this was one of the most used formula at CA inter level to arrive at the value of share? So Priyanka, sorry I missed your doubt. Priyanka was asking, sir, what about this particular thing? This we do if needed. If it is not needed, it will automatically get left. Right? Fine, Priyanka? We will do at a point if needed. But if not needed, it automatically gets left. Sir, this is how you value a share. This is how you calculate the present value of future cash flows. But the question is, which future cash flow? Right from D0 to D infinity? No, from D1 to D infinity it discounts. Sir, what are the things to write? Please observe D1 is dividend per share of year 1. G is the growth rate. In fact, the entire terminology is sustainable growth rate, SGR. You will read about it. We will learn about it, SGR, sustainable growth rate. So G is sustainable growth rate of. Whose growth rate do you need? The growth rate of company, the growth rate of revenue, the growth rate of dividends. Whose growth rate are we concerned about? Sir, we are trying to discount the dividends. So obviously it is the growth rate of dividend is what we are concerned about. So sustainable growth rate of dividend per share from which year to which year? The detailing you should observe, the detailing which you should observe. Is it the growth of the dividend right from year 0 to year infinity? No. Please observe a particular thing. Please observe a particular thing. This is something I could have taught you later, but it's fine if you learn it now. Sir, this is dividend of first year, second year, third year, and so on. If you observe, people in the class, if you observe, these dividends of future years are getting discounted. So growth rate of those dividends does matter to me. But please observe, the first dividend which gets discounted is D1. So the growth that matters to me is from D1 to D infinity, not from D0 to D infinity. The growth from D0 to D1 can be anything. What I particularly need in the formula is the growth from D1 to D infinity. This is the detailing that you learn at CA final level. First, it is a growth of dividend. Second, from D1 to D infinity, which should be constant every year. D0 to D1 has nothing to do because what my formula uses is directly D1. People in the class. Aligned of y'all? Aligned of y'all? Please tell me. Please tell me. I mean, you have learnt these things at C enter level. This is a small formula, but you will be shocked to know the detailings this particular formula has and all these important detailings, important observations we will learn now. And that is where I said outnotes are of use. You write down in the class things that you have to apply in the exam, but certain things you have to understand. There's no point of writing them down. You have matured enough now. They are already written. The focus should be on understanding them, applying them, thinking about their implication, not wasting time in writing them down. Everyone? So Archana, this particular doubt you may ask to me on WhatsApp. Let's not take it right now because you feel that you're not able to explain it properly. It's fine. It's fine. I'll not WhatsApp your doubt. But others in the class, are you able to connect to me? Are you able to connect to me that this particular formula discount the present value of all future cash flows right from D1 to D infinity? Where D1 is the dividend of first year, KE is the discounting rate. We already know growth is the growth rate of dividend from 1 to infinity. People requesting your response, how much out of 10 are you able to understand what the formula is doing for you, what this formula has? Come on, come on, come on. If you respond to me, I proceed ahead. Come on, come on, come on. Everyone in the class, please respond to me. Sir, what if D1 is not given? Everyone, it may happen that examiner may not give you D1. Examiner give you the dividend now. I'm waiting for your responses in the meantime anyways. If the examiner give me the present dividend D0, it may not give you the dividend of first year. Sir, then in the absence of D1, only in the absence of D1, you can apply this particular formula. Sir, what is that formula? That formula is really simple. In the absence of D1, you may apply the formula to be D0 into 1 plus G. Do you agree adding growth to D0 give me D1 divided by K minus G? But do you observe I write down this formula with a blurred ink and write down this formula as the main formula because you have to realize that this is just an adjustment from the main formula. It is not the D0 which matters to my formula. It is the D1 which matters to my formula, which is why I'm saying the growth from D1 to D infinity is what matters to me. The cash flow from D1 to D infinity is what gets discounted, not from D0 to D infinity, which is why this is not my main formula. The main formula is this is just an adjustment formula. This is the clarity of concept I want to deliver to you. Now, certain point of observation. Sir, my first question to you. Since you are anyways extremely comfortable with the formula, do you need a mathematical derivation of this particular formula? I mean, it's all your right to ask, sir, why do we believe and how do we believe that this formula actually discount all the difference from D1 to D infinity, that too which are growing at a constant rate? That's maybe a question you may ask. Point is, if you want me to do the derivation, I'll do it, but it's not suggested because ultimately we will end up wasting time, because even if you learn the derivation, you will remember the same formula which you anyways remember. More important than the derivation is the observation you need to apply in the practical questions. Although we have a place allocated particularly for the derivation, but I won't suggest it frankly. What do you all say? People in the class kindly respond. I mean, it's interesting to know for you, for your curiosity. For me, it's interesting to show off my knowledge of derivation of maths, right? But it ends up wasting a bit of time. Please, people in the class, respond. What do you want? Ultimately, what you do will be done. What you say will be done. Archana wants the formula derivation. Jaswant thinks there's no need. Others, what do you all say? We will do the majority. Archana, only K minus G cannot be explained. There is a mathematical derivation to it. Harshita thinks there is a need. Come on, others. If you participate, Kanika, what do you say? Priyanka, what do you say? Jaswant, you have responded. Shruti, what do you say? Shruti has responded or not? Harshita say yes. Jaswant say no need. Archana say yes. Others? What should I do? You are also interested to know. I mean, come on, come on, come on. So let me try to do it. Yeah. People in the class, let's take the derivation. Sir, do you agree? See, derivation, write it down with the pencil. The purpose of writing them down with the pencil is that really simple. If you write down everything with pen, on last day, when you have to revise everything from 1.5 day, in 1.5 day, you should be able to clearly know what you have to ignore. For example, derivation you have to outright ignore has nothing to do with the last day, has in fact nothing to do with your first revision of those 4 months. It is interesting to know only at this point right now in the class. Yes. So write it down with the pencil so that it doesn't distract you towards the exam preparation. Sir, do you agree that I have D1 to be received at the end of first year? Similarly, D2 to be received at the end of year. Similarly, D3 to be received at the end of third year, and till D infinity, this will continue. And sir, I know that I have to discount all these future cash flows to calculate the value of the share. I mean, you have to please appreciate, not to me, but the formula, that the underlying logic, that fundamental principle continue to remain. The principle continue to remain that you have to discount all the cash flows right from D1 to D infinity, where the first cash flow being D1, because my logic is present value of future cash flow. The value so arrived is called as intrinsic value 0. Can I say this is nothing but, if I have to write it down mathematically, can I say it is nothing but intrinsic value at 0 point is nothing but D1 divided by 1 plus k to the power 1 plus D2 divided by 1 plus k to the power 2 and so on plus d3 divided by 1 plus k to the power 3. This goes on till infinity. Similarly, do you agree? d1 divided by 1 plus k to the power 1 is fine, but d2 is nothing but d1 into 1 plus g divided by 1 plus k to the power 2. How do you calculate d2? d1 into 1 plus growth. Similarly, how do you calculate d3? So these, how do you calculate d3? One second. How do you calculate d3? Sir, it is d1 into 1 plus growth to the power 2, because you have to grow your dividend twice to reach from d1 to d3, divided by 1 plus k to the power 3. It goes on till infinity. Do you agree till this point? First of all, you tell me that, because now I have to insert the flavor of maths to it. Do you people agree? d2 is d1 into 1 plus g, d3 is d1 into 1 plus g to the power 2. Similarly, discounting it, d1 is 1 plus k to the power 1, 1 plus k to the power 2. Similarly, 1 plus k to the power 3. Agreement, disagreement, people? This is how we have to discount all these future cash flows. Agreed, sir. If you observe, do you realize? Do you realize? Please observe that above series is a geometric progression where ये जो ऊपर वाली सीरीज है ये एक ज्योमेट्रिक प्रोग्रेशन है. ज्योमेट्रिक प्रोग्रेशन का मतलब पता है क्या होता है? जिसमें एक पर्टिकुलर नंबर मल्टीप्लाई होता है. फॉर एग्जांपल 3, 6, 12, 24 is a geometric progression where first terminology is 3 and the multiplication factor is 2. Are you understanding me? Geometric progression. So similarly, this is also a geometric progression where first terminology, whom we call A, is d1 divided by 1 plus k to the power 1. One second, let me not write it with this ink. Wait. Where first terminology, which is called as A, is nothing but d1 divided by 1 plus k to the power 1, or just d1 divided by 1 plus k. And do you know what is R? That factor. What do you call that R? Can anyone help me recollect the maths? I mean, I remember learning it somewhere in my 8th standard. So what is that terminology R called as? That factor of multiplication? Geometric factor, I don't know. What do you call it? Anyone, any guess? Let's Google it. Hold on for a second. Let's Google it. Sum of infinite GP. Oh, common ratio. I got to know it. That's called as common ratio. Thank you so much. So, first term is A, right? First term is A and R is the common ratio. So, R, common ratio with which your number will increase, which is called as R, is what? Do you observe? Second terminology as compared to first terminology is increasing with, if you observe, the second terminology as compared to the first terminology is increasing with 1 by g divided by 1 by ke. The third terminology as compared to second terminology is increasing with 1 by g divided by 1 plus ke. Can you please observe it? See, it is nothing, it is 1 plus g, it is 1 plus g square. 1 plus k, 1 plus k square, 1 plus k cube. So the common ratio is nothing but, if you observe, 1 plus g divided by 1 plus k. Do you all have that agreement? People, what do you say? To first terminology, if you multiply this, you get second. To the second terminology, if you multiply this, you get third. To the third terminology, if you multiply this, you get four. So that is a common ratio by which all your terminologies are increasing, and that goes till infinity. And can anyone in the class look at it? The Google says the present value, the sum of an infinite geometric progression. It's an infinite geometric progression. Yes, we have to sum of it. Yes, present value of all future cash flows, sum it, is a divided by 1 minus r. So I will say now, people, sum of gp is equal to a divided by 1 minus r. Sir, what is my a? A is d1 divided by 1 plus k is the a, whole divided by 1 minus r. So 1 minus 1 plus g divided by 1 plus ke. Hello, people in the class? Are you all able to understand? A divided by 1 minus r. So 1 is this, r is the entire terminology, and a is d1 divided by 1 plus k. If you try to solve it, let's say what happens. Let's see what happens. That is equal to d1 divided by, do you people observe? So let me write it down, because you may otherwise get confused. d1 divided by 1 plus k is the first thing. d1 divided by 1 plus k whole divided by, because I don't have a space left to write actually, wait. So that is further equal to d1 divided by 1 plus k whole divided by 1 plus k minus 1 plus g whole divided by 1 plus k. Could you observe I have simplified the denominator? Could you agree to me with the simplification of the denominator? Did you observe it? So basically what happens is that 1 plus k gets multiplied here. So 1 plus k minus entire terminology 1 plus g divided by 1 plus k. And now people in the class, if you observe, 1 plus k gets cancelled with 1 plus k. What I am left with is d1 divided by 1 plus k minus 1 minus g. So 1 gets cancelled with 1, and what I am effectively left with is d1 divided by, if you observe, k minus g. What I'm left with is d1 divided by k minus g. It is a mathematical logical derivation for the formula of Gordon's that you wanted to know in this class. Oh my God! Do you observe how could such a complicated thing gets converted in such a simplified formula of d1 divided by k minus g? Are you people now 10 out of 10 set on this particular thing? Please tell me. Everyone, you will have to please particularly respond to this. Are you people actually 10 out of 10 set on this? Come on, what do you say? Even if you know this derivation, it is your personal satisfaction that has happened. What ultimately goes to the exam is d1 divided by k minus g. But now when I have explained it to you, you have to please understand what is the first terminology I am discounting, d1. What is the first terminology I'm discounting? D1, if you observe. Which is why what finally goes to the formula is D1. In the absence of information, you can take D0 into 1 plus G first. Second, now you have understood the derivation, I have rights to re-explain everything in a better way. Sir, the growth that matters to me, the constant growth that matters to me, please observe, while calculating D1, is there a growth that has come to the picture? No, sir. The first growth that comes to the picture is while calculating D2, which is D1 into 1 plus G. Did you observe? Am I anywhere saying D0 into 1 plus G? No. It is D1 into 1 plus G. The first growth that comes to the formula is from D1 to D2, then from D2 to D infinity, D3, and then till D infinity, which is why we wrote down in the class that growth is from 1 to infinity that matters to me, not from 0 to 1. Now when you have derivation, you have a better understanding of everything which was being written. Right? Perfect. Now some point of observation. As I say, if you didn't get it, if you don't write it, it is all fine. The choice is yours, has nothing to do. It is just for your personal understanding and satisfaction. Perfect. So great. Sorry for making use of Google because it's been very long I remembered this formula. Okay, I knew the underlying logic, but the formula and everything for maths at least I didn't remember. So when I come to you, frankly, let me tell you, I don't come to you with a practice. In my teaching, you will observe that I don't have a presentation with which I come to you. I simply come to you with a neutral mindset. The way I think, I deliver my thoughts to as it is to you, so that you can also learn to think in that manner. So what I'm trying to teach you right now in the class is trying to teach you how to think. Learning to think is what I'm trying to teach you. Perfect. So which is why it may happen that my teaching pattern sometimes you may find so natural, so unprepared, because I don't come here to present anything. I just come here to share with you in a very neutral way my thoughts. Yes. Archana says, just to understand, do you mean to say present value has no relation with D0 if D1 is already given? Yes, PV has no relation with D0. Present value of future cash flow. In finance, understand the common logic, Archana and everyone. When you make an investment at 0 point, when is the first return you get? Is it the return on 0 point that you get? No. When you make an investment at 0 point, the first return will be after a year. That you have to understand. So to calculate the value here, the first discount, the first return you discount is D1 or the cash flow of first year, not 0 year. Yes. That's already assumed that D0 has been received, and after receiving D0 I'm trying to value a share. So now the first dividend I will receive is D1, the future cash flow, not the present cash flow. Perfect. Now certain things before we call it a day. Certain things. First, really basic. Sir, K has to be a bigger number, G has to be a smaller number. Otherwise, please observe. K has to be a bigger number, G has to be a smaller number. Otherwise, this formula will not work. First relationship. Second, please observe what is used is D1 and not D0. Obviously, we know that. Please observe the price that is being calculated is at 0 point despite using D1. What you use is D1, but the price that's calculated is at 0 point, which is fine. Sir, growth is from D1 to D infinity, that is also fine, which means you have to please realize everything that I spoke in the last 30 minutes. Formula is written. Other important conclusions and relationships are pre-written. You got them, you have written them at the right place without wasting the time, right? And the last and most important is growth in EPS is equal to growth in DPS in some situation, and further discussion on that is needed, right? But that discussion is going to take time, right? I will tell you what I'm trying to teach. I'll tell you what I'm trying to teach, right? But we will discuss that in the next lecture, because it will otherwise be stretching the lecture too much. But for now, I will just only tell you what I'm trying to teach. I am trying to teach, this is 0 year, let's say. This is 0 year, this is 1 year, this is 2 year. At 0 year, let's say my EPS, the profit I have made, for example, is rupee 100. Fine, sir. Let's say the payout ratio is 50%. So that way the dividend I'll be able to make at 0.0 rupee 50. Do you all have that agreement? Obviously, yes. Sir, suppose the earnings of the company, grow by 50%, by 10%, sorry. Means profit for the next year become rupee 110. Right? Then question is, how much will the dividend grow by? Question is, how much will the dividend grow by? Is it the same 10% or some other percent? How much will it grow by? Sir, it will grow by 10%. You know what is the condition for that? You have to understand. How much will it grow by? Sir, it will grow by 10%. It's really simple. Sir, the payout ratio, which is right now 50%, if the payout ratio continue to remain 50%, which means my dividend for next year, for first year, will be rupee 55. If the payout is same, 50%. So 100 into 50% is 50 and 110 into 50% is 55, which is why the growth in the earnings will be same as growth of dividend. In other words, growth of earning will turn out to be the same for as growth of dividend, and if the payout ratio is maintained, the growth are same. However, if the payout ratio changes, then what happens, that we will learn in the next lecture. But for now, I wanted to explain you the scenario when growth in earnings is equal to the growth in DPS. It is going to extremely help you in the practical question, because it is the clarity of your concept. You have to please understand the approach with which we learn in the class. We make the things conceptually very clear. Examiner will say the earnings of the company is growing by this percent, but your logic will say, but sir, I need the growth of DPS, not the earnings. What is G here is the growth of DPS. What question says is the growth of earning. So then you will have to apply this particular concept, that is my payout ratio constant. If yes, then earnings growth is equal to DPS growth, and that DPS growth I can use in the formula. If the payout ratio is not constant, if the two growths are not same, then I cannot directly use the earnings growth as the DPS growth, is the point you have to please understand in the class. People in the class, are we all 10 out of 10 set? Please respond. Till this point at least, till this point. Yes or no? Who's this? Rashtra. Is your name Rashtra? Rashtra Bilash. I was your student in 2024 batch. Just came here to say hi, hello. I'm a CA today. Thanks to your teaching style, got an exemption in AFM. That's really great. That's really great. Really happy to see you as CA. Succeeding. Perfect. So everyone, that was all for the day. I hope the lecture has made sense. People, again, as I say, if you found the lecture to be helpful, if you found the lectures to be fruitful, I request you to put down first a like to the video, it deserves. Second, your genuine comments, your genuine feedback about your learning, about your experience. Please put down. Any student who want to start watching this lecture will read these comments and get the confidence before watching the lecture through your comments. Yes. So if you feel it as a responsibility, kindly do it for me. Yes. Thank you, boss. Thank you so much. Let's meet back again in the next class, which is tomorrow. All right. So see you all the live people, recorded people. Thank you so much, Archana. I'll check your my WhatsApp. Thank you so much. Bye, Archana. Bye, Priyanka. Bye, Kanika. Bye, Shruti. Bye, Jaswant. Who else is here in the class? Bye, Nagin Babu. Everyone. Bye bye. See you all. Thank you so much, especially live people, for coming here, talking to me, interacting with me. Thank you so much. Bye bye. I'll see you all. Take care.